Hi everyone, welcome back to Corporate Decoder. Today we're diving into a Form S1 filing, so buckle up because just like finding oil, sifting through these documents can be a bit of a gamble. We're talking about EON Resources Inc, a player in the oil and gas patch. We'll dig into what they're planning, what risks they face, and if this energy company is set to spark or sputter. If you appreciate getting the insights from these corporate documents, make sure you're subscribed. And hey, we've also got a Discord community where you can discuss this and more. Link is down in the description. Now, let's get into the report. First off, this isn't about EON selling new stock to raise money. Instead, it's a registration for existing shareholders to sell their shares. Think of it as setting the stage for them to potentially cash out. The filing says they want to start selling as soon as practicable, after this registration becomes official. Now, EON considers themselves a non-accelerated filer and a smaller reporting company. So let's translate, they're not one of the big boys and they get to skip some of the more detailed reporting requirements. EON Resources wants to allow some shareholders to sell up to about 7.8 million shares of their Class A common stock. This includes shares that might be sold to White Lion Capital under a previous agreement, shares given for services, and shares related to another purchase deal. They want to offer these shares on a delayed or continuous basis, which, under something called Rule 415, allows them to sell shares over time instead of all at once. So the selling security holders, that's just a fancy term for the people who want to sell their shares, are looking to offload about 7.8 million shares of Class A common stock. Those shares break down into ELOC shares, service shares, and Meteora shares, which have the following consideration. A purchase price yet to be determined for the ELOC shares as described herein. The service shares were issued in consideration for services rendered with an average effective price of $0.71 per share of Class A common stock for the other two such selling security holder, and 1 point enduring per share as described herein. The service shares were issued as a settlement of obligations with an effective price of 1 consideration per share of Class A common stock for the other two such selling security holder, and 1 consideration per share of Class A common stock for the other two such selling security holder, and $1 per share of Class A common stock for one such selling security holder, and 150 per share of Class A common stock for one such selling security holder, and 1 dossier as were issued. A key part of EON's story is their purchase of Pogo, a company focused on oil and gas production. This deal officially went through in November 2023. It's important to know that EON won't get any of the cash from these sales. It only satisfies certain registration rights the company has granted, with proceeds only coming from the sale to White Lion. The White Lion deal is an interesting one. EON can choose to sell shares to White Lion, but they're not obligated to. This is under a common stock purchase agreement, and White Lion would then resell those shares. The price White Lion pays, it's 96% of the lowest daily volume weighted average price during a 2-day stretch after EON gives them notice. They've already sold about $9 million in shares, and they could get up to $141 million more from White Lion. White Lion also resold 825 million shares that were registered under the prior registration statement, so there is 1.65 million shares remaining unregistered. Now, the filing also states that White Lion is considered an underwriter, so they are taking on the risk to sell the shares, but under the 211 section of the Securities Act. Their stock isn't exactly soaring right now. On May 8, 2025, it was trading at just $0.41. And given the current market price of the Class A common stock, selling security holders can make a higher profit compared to public security holders. The filing emphasizes the inherent risk, so let's take a look at them. Going concern is accounting jargon, but it's a flashing red light. It means there's significant uncertainty whether the company can stay in business. EON has a working capital deficit. NTO's eggs are all in one basket, the Permian Basin. This makes them extra vulnerable to regional problems like supply issues or regulatory changes. Title defects, basically issues with who owns what mineral rights, can make a property worthless. Their plans to grow and develop those leases might not pan out because of limited capital or other factors. The White Lion deal, while providing cash, could also hurt the stock price because of the discounted purchases. Falling oil and gas prices, of course, could force them to write down the value of their assets. One of the biggest risks they talk about here is that the sales to White Lion are made at a discount, which may hurt the stock price. There is dilution of existing security holders. As the sole working interest owner, the company benefits from the continued organic development of its acreage in the Permian Basin. But they depend on outside parties for transportation and processing, which they have no control over. A cyber attack could really mess things up for them. Ouch! This means they believe their financial reporting isn't up to par. This is a big deal and could really shake investor confidence. Scroll summary, historical consolidated financial information, CASM numbers. Here is some summary data from a resource and summary data from a recent financial filing for the year ended December 31, 2024. Pogo's audited consolidated financial statements showed revenue was $19.4 million, BAM, compared to a combined $24 million ILK to $4 million in the year before. In this report, the net income loss per share of common stock also came in at 140, an increase from the year before, which was UZI increase from the loss in the year 2023. An increase from the loss in the year 2009 night H rise of 1,3. In this report, the total current assets came in at $5,159,159.779. This shows a massive working capital deficit. However, total oil and natural gas properties net came in at $97,525,925,925,912. So what's my take? Well, EON is clearly in a tough spot. The biggest red flag is that going concern warning. That paired with ineffective reporting makes them appear to be in a dangerous position. There are also the purchases made to White Lion. The sale and issuance of Class A common stock to White Lion will cause dilution to existing security holders, and the resale of the Class A common stock acquired by White Lion, or the perception that such resales may occur, could cause the price of our Class A common stock to decrease. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. And hey, don't forget to check out the Discord community in the description. Thanks for watching. See you next time.